Hello everyone and welcome back to Finance with JCL, here to help you on your journey to financial freedom. And today the question is Dropbox. Is it a stock worth buying? So I want to do a nice run through of the financials and I'll calculate what I believe the valuation is. And I guess the question is going to be, am I going to fill up the shopping cart with Dropbox? Dropbox trades in the US, I believe, on the NASDAQ, and the ticker symbol is DBX if you want to find out more. Just to position this in terms of all the different content on my channel, this is kind of what you might call at stage 5. So you've moved on through the sort of personal finance and the principles of investing. Going to be looking at the company reviews. So I've got a full playlist of companies that I've reviewed and looked at in a bit more detail like this if you want to see more after this one. Okay, just as the usual disclaimer, make sure you take your own decision of personal advice. Don't buy or not buy something because I'm doing that. So this show isn't official investment advice, and of course your capital is at risk when investing. And the current state of play is I don't directly own shares in Dropbox. Cool, so let's get on with the interesting bits. And we're going to start off by looking at Dropbox's revenue and earnings. So now on to Morningstar.com. I've looked at Dropbox and got into the key ratios detail. And there's very clear revenue growth from 600 million in 2015, and the trailing 12 months we're now up to almost 2 billion. So there's definitely a lot of growth happening with this company. And then we have a look at the earnings. It's the next part. So 2015, it's minus 325 million. Not great, but that trend has generally been improving, and the trailing 12 months is the first time that they've made a positive net income, a positive profit of 83 million. Now, my personal view on these kind of relatively young, kind of fast growth companies is I don't like to invest till the point they start making a profit. So in that case, a lot of the risk period has passed, and there's generally still quite a lot of growth to go. So now Dropbox, I'm thinking actually now it's got to that point, so is it potentially something I might want to add to my portfolio? And we have a look at the earnings per share, which is the all-important value, and that's gone from minus 91 cents, and we're now up to positive 19. So the trend is very much positive in the revenue, but also importantly the earnings, because ultimately in the long term it's the earnings that increasing that makes the stock price increase. Okay, next up is the free cash flow and dividend position for Dropbox. So I've gone back to Morningstar, which is a fantastic source of information. You can see here there's no dividend, and I would hope that there's no dividend if it's a fast-growing company, because all the earnings and free cash should be ploughed back into the business. If we look further down, the free cash flow has gone from minus 69 million, and it's just increased every single period, so to 129 in 2016, and all the way up to $491 million of free cash flow. So almost $500 million. So that's an impressive amount of free cash flow. And they seem to be making a lot more free cash flow than their net income. So it's deceptively cash generative. And the free cash flow itself is one of the key numbers that I'm going to use later on when I'm looking at the valuation. Okay, so now I'm going to look at the kind of survivability of the business, which is essentially having a look at the balance sheet to see if there's any nasties on there, like a high amount of debt or what have you. Now, looking at the financial health, we have a current ratio that was pretty worrying in 2016, 0.65. It needs to really be above 1 and ideally a little bit higher. We're now at 1.3. And the other point to look at is now the debt to equity is a bit of misleading information here because it says it's 1.11. When I look at the balance sheet detail, it looks like there's no short-term debt and no long-term debt. And having a look at Simply Wall Street, they also confirm no debt. So from what I can see, at least at this very high-level view, there isn't actually any debt in the company. And here is the Simply Wall Street. You see there's been no debt for a couple of years according to this information. Okay, now having a look at the balance sheet detail on Morningstar, you can see there's actually over 1 billion in cash sat on the balance sheet. That's a really good amount of cash in the business, particularly if there isn't that debt in place. Okay, now we look at the industry and moat. So I guess the question here is, if the industry has been very much boosted and accelerated by the kind of increased amounts of remote working from home, kind of collaboration. And if we look at what Dropbox does, it's essentially collaboration services to varying degrees for both individuals and for businesses. I think it's a well-known name. It's been around for a long time. And according to Simply Wall Street, they've got over 600 million registered users in over 100 countries. So this is a company reach that stretches far and wide, and there's a good audience there for them to increasingly monetize in the long term. So I think they've got a decent moat, and they're in an industry that's going to be around and only increase as time goes on. Now, of course, they will have some competition. They do have competition. There's Microsoft Teams offerings. There's Google services as well with Google Drive and those kind of things. So there's definitely competition, but they have carved out a good user base, and they are now profitable and generate a lot of cash. Now, management, the all-important management. So let's have a look at the return on equity and also the insider holdings. Right, back to Morningstar and the key ratios. So the return on equity is now positive at 10.27%. It's not an amazing number, but it's fine. And it's definitely going to be increasing, I think, as we go on. So look at Simply Wall Street, looks like the individual insiders, according to their data, own 32% of the company. And this is a really good example of where the insider got skin in the game, so you can be sure that they'll be putting in a good effort and doing their best to make some really strong decisions, because they themselves will benefit as big shareholders. Right, next up is price and value, and I don't think we can use the book value here. That's probably not going to be appropriate for this company, so we'll look at a couple of different methods. So having a look at Yahoo Finance, first of all, we notice that the current PE ratio based on the recent data is insane. It's almost 120. So normally a company in that situation, I would immediately discount and not buy it at that PE. However, I thought let's just look into this a little bit more. So first of all, their forward PE is only 22. And the price to sales is 5. So again, that's not crazy if we're trying to value a growing company. Now here comes the interesting part. Looking at Simply Wall Street, the analyst data there suggests a 42.6% annual earnings growth. Now that's incredibly high. And if we have a look at the data here, current data suggests earnings of $83 million. So if we divide the current 80-odd million against the projected earnings, 642, that's about 8 times higher. So we take the PE of 120-ish, divide it by 8, you're looking at a forward PE of 15, which sounds far more attractive than the current PE, and actually seems like pretty good value. So story and category. Now, I think we've kind of touched on this in terms of the industry. I think there's definitely a lot of growth in the industry. The company has a lot of users, as well known. And in terms of the Peter Lynch classification, this would be very much in the fast grower category with very fast projected earnings growth. I think that leads us to the most important part, which is the calculation of the intrinsic value of the company to compare what we think it's going to do. Sorry, not compare, to try and guess what we think it's going to do over a period of time in the future based on projections and past data, and then compare that to the price to see if we've got ourselves a good bargain or not. So the first thing I want to look at, that free cash flow, that 491 million. Now I've taken a 5-year growth rate for that of 20%. So the Yahoo analyst was a bit lower than that. But the Simply Wall Street was saying 42%. So I've kind of gone for 20% as a reasonably conservative, and I can see their earnings growing at 20% a year for the next 5 years. After that 5-year period, I've used a kind of perpetual ongoing growth rate of 3%, and I want a minimum of a 10% return. So therefore, the discount rate I've used for the cash flow that it generates is 10%. Now that gives me an intrinsic value of about $49, so $48.85. And the last check on the price is $22.63. So that means the price is less than 50% of what I think the intrinsic value is in the long term. That's a margin of safety of 54%. So even though it's a fast-growing company, we've looked at that forward PE, which potentially could be argued to be as low as 15, and the amount of cash it's generating, which is a lot, there's a 54% margin of safety there. And I always like to check another source on the intrinsic value just to make sure I haven't gone too crazy. So the Simply Wall Street is saying, yeah, they are 58.2% undervalued. So they're reckon they're worth about 54, so slightly more than me, but in the ballpark. So looking at this, it looks like a buy to me. No debt, stuff's happening, and they look very much undervalued. So that's it for today. We've got Dropbox. I will be filling up my shopping trolley with Dropbox, as we saw at the question at the start. And the reason I've reviewed Dropbox is actually due to my VIP patron who suggested it as a company for me to look into. So thank you very much for that. And if you want to join the Patron Supporters Club, if you'd like to consider that, I'd be very grateful. And then you get a bit more access where we can sort of talk one-to-one, or indeed as a group, on these subjects. So if you've enjoyed the format and the information, if you could hit the like button on YouTube, that would be appreciated. And yeah, I look forward to seeing you on the next one.